Welcome to Signet Financial's Mid-Year Outlook. My name is Steve Tuttle. I'm the Chief Investment Officer of Fixed Income and a partner here at the firm. "2017 is off to a fairly good start. Most asset classes are nicely positive so far, both on the equity side, U.S. and foreign, and on the fixed income side. I'm going to highlight some themes that we think are particularly relevant right now as we look forward. One important theme has to do with valuations in the stock markets. U.S. markets are not cheap. Valuations are starting to get stretched, but earnings have accelerated, and so we're comforted by that. The important implication of valuations is at these levels, it's to be selective and to seek relative values. There are definitely some pockets of opportunity and sectors and individual situations that we believe are more attractive at these levels than others. And it's important to be active in trying to capture those opportunities and perhaps avoiding other opportunities that are a little bit more stretched on the valuation side. Another important theme has to do with the economy, particularly the global overall economy. We believe that picture is brightening. Foreign markets are improving. U.S. markets are still doing well, and we think overall global equities should benefit from that economic improvement. Market trends suggest there may be value or opportunity found overseas. So we strongly encourage all stock investors to consider foreign stocks. If you're a client of ours in a balanced allocation, you already have that exposure. But if you're just focused on the U.S. markets, we'd encourage you to look at the foreign markets as well. On the interest rate side, the Fed is continuing to raise rates. We think that process has been gradual, and we expect that to continue. We don't expect a lot of disruption on that side coming from the Fed. And we do want to make sure that our clients understand that now's not a time to give up on bonds just because rates are rising. Bonds still play a very important role in reducing equity risk in balanced portfolios. And lastly, there's a lot going on in Washington, D.C., a lot of chaos, I think is a term that's fair to use. We'd encourage you to focus on the fundamentals, not the politics, and avoid the noise. That's certainly where we spend most of our time, and that we believe is very prudent in this marketplace. Now, most of our clients know we spend a lot of our time analyzing data and relying on evidence to frame our decisions on the investment side. And so I'm going to show a few slides and charts that we think are particularly relevant now. The first slide has to do with corporate earnings. The pace of earnings growth in the U.S. looks strong, and this chart shows the S&P 500 consensus analyst estimates all the way on the right in green are much higher, and the gray lines show where they've been. So after a decline or a slowdown in earnings between about 2014 and 2016, we've seen the pace increase, and that certainly seems to be a trend that will continue. And what's important to us is that as long as corporate earnings can improve, we believe equity prices can move higher. This is a little bit of a complicated chart, but I think it's very important to point out the opportunity in foreign markets. So the gray line represents the S&P 500, and the purple line represents foreign markets, both developed economies and emerging market economies. And coming out of 2008, the U.S. market has done far better than foreign markets, with a 258% return for the S&P 500 cumulative, compared to just a 100% return for foreign markets. That's coming That's compared to the bottom of the 2008-2009 recession. It's also pointed out on this slide how there's a valuation advantage in foreign markets in the purple, with a PE ratio less than the foreign markets PE ratio, or price to earnings ratio, is cheaper than the U.S. markets. And so I want to point this out. It's something we're watching. Not only that valuations are somewhat attractive and foreign markets are finally starting to perform this year relative to the U.S., but there's still a big gap between U.S. and foreign, and the potential for that gap to narrow is great, and that could create an opportunity and potential gains from here for foreign markets. Another interesting chart has to do with the yield curve, and the yield curve is essentially the amount of interest a bond investor receives buying short-term paper all the way over here on the left compared to long-term paper. And you can see that the yield curve slopes up. The longer out in terms of maturity date that you're willing to go, the more yield that you receive. What's been going on this year so far is that short rates have risen. So compared to January 1st to this week, short rates have risen. And on the long side, long rates have actually declined a little bit. And so that's a term referred to as the yield curve is flattening. And what we like about this scenario, this yield curve, is that there's a sweet spot in the middle of that curve that we're focused on. We think that's where you get the most bang for your buck, so to speak, in terms of yield compared to the amount of interest rate risk you're willing to take. So somewhere between 3 years and 10 years, that is what we would safely call a sweet spot of the yield curve. That's where we like to position our bond portfolios now. You may ask yourself, what about the Fed and rising rates? Doesn't that mean bonds are not the place to be? We would say that it's actually the front end of the yield curve that's usually most affected by rising rates. The intermediate part of the curve is usually less affected. So we think maybe don't put all your eggs on that short end of the yield curve. Focus a little bit more on the intermediate. On the long end of the curve, perhaps you're not being compensated enough, so maybe don't stick your neck out on that side as well. Stick to the intermediate part of the yield curve. Now, all this information is good. I think it's very useful information, but I want to take this opportunity to point out what I think is the real true value of a good advisor. And we pride ourselves here at Signet Financial of being able to translate data and information into a plan for you to generate the outcome that you want and need out of your portfolio. So this pyramid here starts at the bottom with all this information, and today we have an information overload. There's too much information available, whether it's through your phone, through the internet, through TV, through blogs, through social media, or all traditional newspapers and magazines. There's a lot of information out there. That's not true advice, and it's certainly not personal advice. So what we as advisors try to do is take that information, form some strategies and ideas that we think make sense in the environment today, combine that with the personal insights and goals of each of our clients, and design a plan that we believe helps each of our clients reach their goals or achieve a certain income or output from their portfolio. So your outcome that you're looking for could be generating income, it could be growth, it could be a combination of both. That's the true value of an advisor. That's where we spend, I think, the most amount of our time working with our clients to achieve the outcomes that they need from their portfolios. So I'd encourage you to reach out to me if you have any questions about any of the information presented here, or just want to speak about your situation. I'm available. My email is on the screen here now. My office phone number, 973-543-6660. And if you're a social media user, I'd encourage you to follow us on Twitter at SignetFin on Twitter. I thank you for your time. Enjoy the rest of your summer.